Okay, so we are live here Monday of CPI week and uh, quite the nothing burger. So again, we could start out on a smaller time frame here just to kind of go through because really a whole lot of nothing. So you'll notice here I have that London kill zone mapped out from 1 a.m. Eastern to 5 a.m. Eastern. I map the highs and the lows of that range, and from that point I wait for one side to get tagged and wait for that first imbalance to form in the opposite direction. There it is. And from there, the target for that could be your low of that kill zone, right? So simple enough. Again, we've gone through we market every day, so we're 8 days into April, and I did the last week of March as well. And um, there's been two scenarios I think where it hasn't played out effectively in sample size of like 7 days. This is something that you can continuously back test, but ultimately the way that you can look at something like this is, despite showing that it is effective, how can you protect yourself in a situation where you might be you might run into it on a day where it doesn't play out as expected. And ultimately, very similarly to really everything else that we trade, at least we have some sort of structure, right? So what I mean by that is, if you are to see this candle form to the downside here, you can have your stop loss set just above the high of the candle that created that imbalance to the downside. And ultimately, from that point, again, it's just about structure, right? Why would I not look to be, taking shorts on these candles here? And ultimately, it's just because I don't have anything that I can base this trade off of, right? Let's just say I caught the tippy top of this candle here on a short. Well, next candle, I got stopped out, right? So ultimately and overall, I'm just always looking for some sort of structure in a way that I can, justify a trade and also stop out in a position where I'm not going to get completely wiped if, I'm wrong in a specific situation. So, but anyways, imbalance forms, ultimately targeting those lows and taking them out. From here, we're going to see something. You might hear Ryan, he talks about this a lot actually, but the idea of seek and destroy, and I don't think seek and destroy is a very a crazy thing to I guess forecast. I don't even know if that would be the right word, but going into a week with no high impact news data prior to a CPI read, which is coming on Wednesday, as we kind of spoke about last night, where we said not really anticipating much of anything going into Monday or Tuesday due to obviously no data coming in on those days. But um, also it's pretty ironic on where we currently sit on this chart from an hourly perspective. And you look at this here and you can obviously note that you got to be real quick in this environment, right? But also look where we are making this type of consolidation type move, and it's in that showtime imbalance, the one we talk about right off, um, which is currently in hourly range that is bearish, ultimately. But our higher time frame still suggests higher prices, right? Again, no imbalances formed on the weekly, no imbalances to the downside, or even a market structure shift on the daily time frame. So despite us technically being in a bullish state of delivery, we look at an hourly chart and you'll notice that this is a bearish range, right? But this is one where, although we are getting sticky in this discount area, specifically that imbalance on the hourly time frame, um, this really isn't a setup that I'm looking to trade. Could this complete my model down here at 18051? For sure. But why would I look to not necessarily trade this? And really, simply put, is I just like when they all line up in terms of direction on multiple different higher time frames, and I can go top down. Typically, when you go top down and everything lines up, meaning if we're bullish on the weekly, bullish on the daily, bullish on the hourly, typically those are the highest rate of success type trades that you're going to take, and those are the ones that I want to take. I don't really want to be caught up or involved in any of this nonsense here. So again, just putting that all together, can we justify why price is getting sticky and not really moving all that much in a small period of time. What is this, since Friday, really? And I would say, yeah, you do have a discount bearish imbalance. You don't have any news over the next 2 days to kind of give us some juice to move forward. Somebody had said that lowest trading volume was today, and you know, do, you know, I don't want to sound like a jerk, but with that information, like, did you really need it to know that we probably weren't going to move all that much? Just knowing that we really haven't taken out any high or low recently. Look at the daily as well. We're just sitting inside a range right now, and it's not doing all of that much. So again, I didn't even take any future trades today. So and I don't want to say, never say never, but I'm currently not really going to be searching all that hard for one tomorrow. If it comes, great, so be it. If not, it is what it is. I'll look for CPI on Wednesday, where delivery should clean up quite a bit. But really, just much more slow-paced movement over the last couple of weeks up here after taking out those all-time highs. It's really been 2-3 months at this point. But just again, to review the rest of the day, our seek and destroy conditions, which is really just a liquidity sweep on one side, looks for liquidity on the other, and it's essentially creating that megaphone for you heathens out there who believe in that stuff. But that's what it's essentially creating. It's taking a high, going to look for more liquidity in a low, and it's really just gathering liquidity in a specific range, so that again, leading into some sort of high impact data, which we do have coming, the necessary liquidity for a powerful move is there, and I fully expect that to happen. Directionally, again, I'm not going to try and front run this. Am I in some stuff on their own? For sure. A lot of the stuff that I've been trading, you've probably noticed, has not been any of the big tech names with heavy weighting in SPY or in QQQ. And, ultimately, to bring it all together, we've run quite a bit since October. I'm not going to be the one to call top because, those who have called top over the last couple of months, like 100 times, have been stopped out every single time. So I'm not going to do that. To me, again, this is something that I continue to echo, but I'm just waiting for one imbalance to form to the downside, and from that point, I will feel fine with looking for lower prices, specifically to get us into discount of our most recent bullish price run. So until that moment, I'm going to look for higher, right? Could this be the candle that creates that imbalance to the downside? Sure, could. But to front run that, to me, risk reward, not really there, knowing that at some point or another, historically, we will come back and get another opportunity to look short in these imbalances. Here's one, here's another, here's another right here. So here's another, there's your wick. So there, oftentimes you will get another opportunity. So I'm not sweating that all that much. But, honestly, best case scenario, really don't care which direction, but make some sort of imbalance on the weekly. We haven't had one since, let's see, January 16th was our last imbalance. And we're currently digging into a bullish weekly order block here, but not really all that tradable for me on a smaller time frame. So just looking at it from that perspective on the higher, not really all that much information that really can be helpful for us. So it really has been smaller time frame trades and using the smaller time frame to operate. So that's that. At least that's just the overall market and directional bias I'm taking. I mean, even if you look at the dollar, dollar's most recent bullish price run. Okay, we did get that discount retracement into a bullish imbalance, running up into a bearish imbalance right here before rejecting. So sometimes it can be fuzzy, and that's okay. And that's how I feel on NASDAQ right now, right? There's some setups where I'm way more gung-ho in one direction, but here in this situation here on the overall market, it's very difficult to say. And I'm sure people are calling for both. They could be calling, oh yeah, we're gonna rip the faces off and everything like that, or they could be saying that we're top is in, time to retrace and all of that. And to me, it's just that's much more speculative, and it's cool to go back and say, oh, look, I called it right and everything like that. But if it's not really that tradable, because especially on top of everything that I've said, this is a massive range down towards 50%. It's about 2,000 points. So with all of those, variables there, like how tradable is it really? And if you're right, oh yeah, of course it's tradable. But if you're on the wrong side of that, you can get shredded quite a bit. And these moves have been pretty big over the last few data drops that we've had on the indices as a whole. So, but that's just kind of overall on the indices there, on kind of where I'm at and how I'm kind of treading lightly. And hopefully Wednesday will be the day to clear everything up. And even after Wednesday, we're not really out of the woods. There's PPI, and if I'm not mistaken, we have GDP on Friday too. So there is a lot going on this week. But typically when we do have those data drops, I'm not saying that I front run them, meaning I buy it at like 829 and or sell it at 829 and hope to be on the right side of things. You'll just notice that when that influx in volatility comes, oftentimes price action is just much more smooth. Again, something you can backtest if you were to go back in time and look at all the previous CPI dates. I'm sure you could just Google that, go through historically, and you'll notice that a lot of the time price moves a lot more smooth and also with some urgency and moves faster. And obviously, if you're trading, a specific imbalance or something, you kind of want it to get in and get out and start moving, because I know this personally, that the longer that I'm sitting in something, the more or the higher the percentage chance of me overthinking something, maybe taking profits too soon as a result, maybe going down a little bit and then just cutting the trade break even when that was the start of that next move higher. Timing is kind of important to me and my style of trading, and just overall like my own I guess it's just my personality. If I'm looking to enter something, I kind of want to get in and let it start moving in the direction I want it to go in. And if that's not the case, usually that leads to I don't want to say flaws in execution, but it could open the door for those flaws in execution. I know everybody's been there, where you've been in a trade and, oh, come on, let's get going, come on. And then you're just rattling through all of the potential possibilities of what could happen here. Oh, well, if we sit here too much longer, I'm going to have to get out because theta's going to crush me. Now you're no longer thinking of where all of the research and the thesis that you put together on where you think price is going, that all goes out the window, because you're just thinking about, oh, I need to get back to even here. If it goes against me, not only did I take the hit on theta, but now I'm getting smoked in direction too. There's just a lot of variables that kind of kick in as a result of that, and I try to avoid those at all costs. So, I am, especially when I'm trading, NASDAQ or SPX or something like that, I really want it to get in and get out. I don't want to be sitting in there all that long. And if I am, usually those are the trades that turn out to be, I don't want to say nightmarish, but headaches, because then after the fact, you're going to go in and you're going to micromanage. Oh, why did I do this? Why didn't I just leave my stop loss where it was? Because if I did that, then I would have caught this extra 10 points, or all the possibilities that can roll in when you're sitting in a trade, specifically a day trade or a short-term trade that you're looking to kind of get in and get out of there quickly. It just opens up a can of worms, and you're gonna have to sit in there and deal with that. And mentally, it's probably not the best. So, so that's overview on what I think ultimately with the market. I mean, today in itself, I'm just going back. Of course, we had the kill zone high low, which was great. But even if we want to talk about like the tradability of this, right? We can go through each candle. I know I'm on the 5-minute right now, but if we were to go through each of these candles here, what was anything really all that tradable? I mean, here's an opportunity, right? A retracement into a 5-minute bullish fair value gap. But this was actually after we had already swept liquidity. So to me, this is a premium fair value gap there. Not really ideal for my trading style, right? Then following sweeping the highs, we'll retrace lower. You actually create a bearish breaker here. High, low, higher high. So here's your breaker candle. And I'm sure it's going to be a little sloppy. Maybe not. There it is. There's your bearish breaker. So there's your first high. Here's the low of the sequence. Here's your higher high. Your break below that candle here. There's your retracement into the breaker and ultimately a flush from that point. And you had a bearish fair value gap. I should add that in there, right there. So that was not a bad setup at all. This was heading out of that 10 to 11 silver bullet time frame. So this was, entering our little lunch range here. So, but even going through, I mean, not many of these imbalances that were created. Well, there weren't really many imbalances created, period. But any of them that were created, you didn't really get an opportunity to come on in. I mean, even this right here. That's a bullish fair value gap right there. And look, here's the thing. Did the bodies, tell the story? Sure. How about these wicks though? How tradable is this? It took out the low of the candle that created that imbalance. That's a difficult trade. That's $7 below. At this point, very easily could have thought, okay, this is the draw on liquidity from this point, right? So just not all that friendly of PA. And, to me, this is probably something that I would have tried to trade a lot in the past. Now, the way I look at it is, look, if it's a wasted day, it's a wasted day, so be it. It's better than me getting smoked and stopped out and killing my confidence over and over again because I'm trying to trade some BS chop, right? Not many imbalances to actually use as the, basis of your trades throughout the day. And even when you got them, I mean, these wicks, these are painful to deal with. So, to me, just very avoidable. You can also look at it from, I know somebody posted this in the chat earlier. There's your hourly, little hourly range. I mean, you can even put it from here to here. I mean, we've just been chopping inside this range for a while. And could we get some sort of manipulative move tomorrow to set up that Wednesday move? Maybe, but I'm not banking on all that much just because we don't have data. There's no external volatility that's going to come into throw things off in this, So that's overall market. Just, I guess, how can we avoid trading this chop? Well, if you don't have imbalances that are setting up, I mean, even a 5-minute might even be too tight. You could look at a 15. Like, was there really, setups that were taking place throughout today? And it's not really the case. So, yeah, that's overall market. We talked about the kill zone there. That was one thing I wanted to bring up. Avoiding that chop and trash. Simply put, if you're using imbalances as a roadmap for trades, and we're not forming imbalances, then is there a trade opportunity really presenting itself? No, probably not. Right. One thing that's becoming a bit more what's the word, prominent, I guess, is just on these types of days I find myself looking more towards the individual names rather than the index itself. Doesn't necessarily mean that there's always going to be a trade setup, but just a little bit cleaner price action versus what we've been seeing on the index at this point. So that could also be a pivot, right? You see on a Monday, if you're at a point where you want to continue to take trades and all of that, if I would just say, you're going to get to a point where you're going to feel like you don't necessarily need to trade every day. But I know it's hard because it took me a while to get into that frame of mind to because then you'll see a move and you'll say, oh, I could have hit that. That makes sense, right? I don't even sweat it anymore. It just takes one trade and, it sets up your week very nicely. So I'd prefer to just wait for a much higher, like an A plus or an A type setup versus trying to scalp, just to make a couple bucks. The risk reward just doesn't add up for me, and that's why I kind of avoid doing it there. But So yeah, that's basically where I'm at. There was one question that I wanted to go over. In this one, it's not all that. This is actually a very common question, so I think it's good that we can talk about it. But it's not gonna take forever. It'll be a quicker one. So if anybody does have any additional questions, feel free to drop them in that sidebar. But if not, we'll roll into this. So the question was surrounding, like, at what point would you deem an imbalance just invalid or void? Like, at what point would you not look towards it to actually carry weight anymore? And the way that I look at it is this, really. I wish I can cherry pick an example or a better example. Let's see. Can I? I guess I could. Okay, we can use this for example. All right, so let's just look at this. That's a bearish fair value gap, right? I think everybody can agree on that. And if that's the case, we didn't anticipate that acting as somewhat of a resistance level, right? But again, going into today, bias is relatively mixed, right? Our higher time frame is more bullish, but our hourly time frame not so much. And in this case here, we did take out a low with that price run, ultimately getting back into discount of that range and just kind of chop and consolidating. And this is overnight when this occurred. Now, at what point would I say, all right, this imbalance is void. I can take this off my chart completely, because it wasn't on my chart. After this move, I guess you could say. So you'll notice price gets into it and rejects, right? Starts to reject it at the very least, right? Then we come back up one more time, sweep these highs, get back into that imbalance one more time prior to rejecting again. One more run up to completely fill this imbalance. There it is, okay? One more rejection down through the bottom of it, okay? At this point, right, this imbalance is completely filled, okay? At that point, this is coming off my chart. I no longer anticipate that imbalance causing much of any resistance at this point, right? Because again, if we just go back to the roots of the idea of that imbalance, it's an imbalance in price in one particular direction, and in this case it would be in the downside or bearish direction, right? If that's the case, we use that, what's it called, the teeter-totter idea, right? We're imbalanced to sell side, right? So one side of the teeter-totter is on the ground, the other side's up in the air, and the more and more price gets into this imbalance, we can think of each one of these candles balancing the price in this range more and more and more and more, right? So as the candle completely fills this, right, for price to get up to this point, right, there you know the orders in all the way up until this point, they have to be coming in to meet that excess, or I guess you could say supply in this case, right? If there's an imbalance, right, there's a void in price in this specific region, right? So in order for us to get up to this point here, to balance out this specific range, for to fill that, then to me price is balanced in that range now, so price can move freely from that point, and that's when I remove them, right? Where would be a situation where you can use an inverse fair value gap? Well, here's like a great example of that, actually, believe it or not. But if you were to look right over here, and you'll notice that on that last run up to take one more high, we made a little bullish fair value gap here. And again, although it's a bullish fair value gap, would it be one that we would necessarily be looking at to trade off of? For me personally, and the way that my model works itself out, and the criteria I need in order to take that trade, I like them when we can get them in discount of a specific run, so below 50%. And this imbalance that was formed up here, it's really nowhere near discount of that run up from this low to that high. And just for visual, you can see here, right, this imbalance is in premium, right? So could price get into that imbalance and move higher? Sure. Why would it be a lower probability trade? In my opinion, is just based on where it is in the current range that we have, right? We are well in premium or overpaying for your longs in this situation. So it really wouldn't be one that I'm looking at as an opportunity to long, right? But you'll notice that if we're using just the overall idea of premium and discount of a range, right? A lot of the time, these inverse fair value gaps, they present themselves in this way, where you'll have, in this case, we did have an added extra little layer that was a bearish fair value gap right there, right? But sometimes you might not get that bearish fair value gap, and you'll only have that previous bullish imbalance, and you've made that candle disruptor candle, right? Just completely overlays it, doesn't really respect it whatsoever. And if that's the case, you can look towards that imbalance again. Whether you're right in a specific situation or whether you're wrong, it's just a way that you can kind of structure a trade off of that specific level, right? You're not just buying off of air because you think it's going down. You have a level that, again, you've seen cooperate over and over again. So this is something that you should definitely try and back test yourself as well. But you'll notice price wicks into it, right? So we see the cleanliness of this, right? You see the little wicks that are getting above, but if you were to short that imbalance here, ideally your stop loss is going to be at the high of the candle that created that imbalance. But you'll look in terms of precision, I mean, look at how it came right up into that previous bullish level, now flipped bearish. And again, you're in premium of a range. So you'd kind of anticipate that to kind of offer a rejection at that point. Now, I'm not so sure we've talked about it all that much, but I guess I could just add it in here. If you have an imbalance in one direction followed by an imbalance in the other direction, that's something called a balanced price range, or BPR. Sean, I'm not sure if Sean's listening right now, but Sean is one who he's got a good eye for these, and he brings them up quite a bit in the chat to everybody. But the way that I look at the balanced price range is I do favor the side of the second imbalance, right? So for example, in this case, you have the bullish imbalance followed by a bearish imbalance. I favor a bearish move from this point. But I guess theoretically, you can look at it and say to yourself, if price is balanced in this range, I think you can justify a price move in either direction, right? So even in this case, after, getting up into this point, and of course you have the bearish breaker, you have a bearish fair value gap, you have an inverse bullish imbalance here. You got a lot going for you in that case. But it might be difficult for someone who is maybe not looking at it from the same perspective we would in terms of your premium above 50% of your range and your discount down here, right? So this, we can totally justify this move down, but somebody who might not be as refined at this point, and you will be, you're going to get better at this, of course, with practice, but you're going to say to yourself, well, I see this bullish fair value gap here, I see that bullish fair value gap here, like, we could get into that and run. So I don't know if I want to take this knowing that I have bullish fair value gaps down below me. But again, it just kind of all circles back to the idea that, we wouldn't really anticipate these bullish fair value gaps carrying much of any weight other than maybe just a speed bump like this one, right? Got into it, bounced, but ultimately not enough juice and sauce to move it back up to that high. Why? Well, to me, we didn't get into discount. There are, some discount levels that we can go address down here in our most recent bullish price run. I've seen it a zillion times on how price likes to retrace down into discount, and therefore that's why these are not enticing to me, these bullish fair value gaps. And, ultimately they get shredded through and we do make that move lower. But, you know, people might see these bullish fair value gaps and automatically think, and I know for a fact this was me when I first started learning ICT, because I was saying, oh my gosh, I'm seeing how effective these bullish fair value gaps are. This is crazy. Price gets into them and then get out of them. And it might have been just a situation where I was seeing price get into them down here and I was like, oh my God, that's amazing. So I started just buying fair value gaps. But then, you come to the harsh realization. You're like, oh man, what the hell? This doesn't work. Like, it got smoked. Adding in the idea of market structure or trend or mapping a range, it's crucial in terms of being able to identify what's going to be a higher probability setup versus what's going to be a lower probability setup, right? You very well could have said to yourself, if you went into it with or from this point of view, I'm going to catch this imbalance, and once we leave it, I'm going to sell it. Right? You could have said that when we get up into that bearish for value gap. You could have scalped, let's just say you caught half of it. So 331 up to 353. That's 20 points. That's pretty good. Do that 3 times a day. You're making $1,200 a day, right? So you look at it from that perspective. Okay, maybe. But to me, this is just, it's not high probability in that, you know, ideally you want to be in this short right here where you get your entry off of one of these candles in that bearish for value gap and it's a swift move lower, right? And to me, just much more effective that way and leads you to a higher probability for success ultimately, right? It is very difficult, especially if you're not trading futures. So if you're trading, SPX or something like that, and or SPY or anything, any name, it doesn't matter. But if price gets into that imbalance and leaves quickly, you're gonna start what's the word? I guess like you're psychologically, you're gonna be thinking highs, right? Um, really good traders will probably say, okay, once we leave that, I'm taking this as a scalp. I know we have this bearish level here and we didn't get into discount of what is a bullish range. I'm just going to take what I can get here. Sure. I've avoided really taking those trades because I just realized at this point, like I can literally just hit one trade that will, with 2 contracts that'll satisfy that, 60-point threshold, which is fantastic. And that's more than enough for me. But this would be probably something that I would do, but by trading futures, I would be able to slide my stop and profit once we started getting that upward momentum. When you're trading the options, you might not be so willing to do so, just because maybe it didn't move as much as you'd wanted it to. Maybe the money didn't look as good. But it can kind of take you out of your element when you look at it that way. But even so, this fair value gap, again, wouldn't look at it as much more than just kind of a speed bump or a little bit of a block in the road, prior to ultimately rejecting it moving lower. So did that answer the question a little bit? Yeah, okay, bear flag. I'm going to carp just because I know you're still in love with that, pardon, but just really not ideal ideology. I'm going to go through about 50 examples. You're going to keep me up all night, and I'll record the video and I'll post it of just how inaccurate that ideology is. When would a bear flag work? When you have a bearish imbalance and discount of a bearish range. Where would a bull flag work? When you have a bullish imbalance and discount of a bullish range. It's just, I'm not just saying this either. My model in itself, like if you really wanted to break it down, that smaller time frame Mando model, if you look at it on a bigger time frame, it's a bull flag. Right? There's just one missing thing when people teach you guys, oh, bull flag, bear flag, this, that. Like, when doesn't it work? Because, like I said, I'm going to go back and I'll get 50 examples of showing you where it doesn't work. And it's just because there's no imbalance in price towards the, for example, on a bull flag, towards the low of, the flag, whatever you would draw your little tilted lines. Like, that you need a bullish imbalance there, and without the bullish imbalance, you're going to notice it's going to fail over and over again, right? How many times do you trade one of these flags and you say to yourself, oh, why didn't it work? That's BS. Like a failed bull flag. You really feel comfortable putting $10,000 trades behind a failure bull flag? Not really. I don't. But you had to get me going, Carp. No, I'm joking. All right, cool, SJ. I'm glad. Yeah. Thoughts on ARM and Tesla? For sure, we can do that. And does it matter what time frame to remove imbalance? Should the same time frame the imbalance was created at? That second part to the question got me a little bit there. Should be the same time frame the imbalance was created at. Well, if you notice here, just up in this, up here on my trading view, I have a lot of different time frames. So, this is a 4 square. I look at this. This is usually individual names. I have, monthly, I don't really need this right now, honestly. But last week I had it up, so I just didn't remove it. But I have the weekly, I have daily, I have hourly, I have DXY on a chart in itself. I have this mess of a situation here that every day I have to kind of clean up. This is a 1 minute, 5 minute, 15 minute on NASDAQ, and then I just have one overarching. It's usually on the 15, but I go through all different names throughout on just this one solo chart, so I don't get that like overload of information here. But with that, there are imbalances on every time frame, right? So like, which one do you pick? And this is a question that I get quite a bit actually. And um, to me, the imbalances on the higher time frame are the ones that I would target the most. Okay, but from that point, so let's say we have an hourly bearish fair value gap, right? If you were to drop down in time frame, inside that hourly bearish fair value gap, you're probably going to have multiple smaller time frame imbalances. For example, maybe you have 3 back to back to back 5-minute bearish imbalances in that hourly imbalance, right? Those smaller time frame 5-minute imbalances that you can use as a trade map, again, just structure, that could also refine your range, because you might notice that if you're looking at an hourly and you see that hourly bearish fair value gap, you're going to be sweating if you're adding, again, you wouldn't want to add prior to 50% of the bearish range. But if you're looking at it here, from 309, right, that would be, your entry point in this case. 487 is the high of that imbalance with, another imbalance above, right? So it's like, that's way too big of a range. Nobody's trading that, right? At least I'm not. So how can we kind of, refine that? By going down in time frame, you're going to find more specific and individualized imbalances within that hourly, right? And they will overlap, but it's just a way. Okay, we're in a bearish fair value gap. Okay, so we're in discount of a bearish range. Okay, check. Let's just pretend that the overall higher time frame stuff isn't bullish on NASDAQ right now. So I'm looking and okay, look, the higher time frame matches up. Boom, boom, boom. Okay, now we got the hourly bearish. Good. Okay, so now I'm going to be looking for bearish setups, because our hourly is a bearish price run. We took out multiple lows here with that price run. By price retracing back up into discount of that bearish range, I feel good. I'm going to start looking for shorts in this situation, right? Huge range. But how can we refine this? Look for smaller time frame imbalances within this, right? Whether it's a 5-minute, 15-minute, you name it. But by using those, not only is your risk limited, wow, but also you're more likely to be on sides, knowing that your higher time frame is playing a role in that lower time frame setup that you're seeing, right? So does that make sense? Does that help? How I kind of broke down there, Van Sad. Because that was like what I was referring to, just overall, and how they're going to overlap, right? In order to create that hourly bearish fair value gap, you're probably going to have a bunch of imbalances within, 5-minute candles. But okay, let's go. While Van Sad answers that, let's just do, because I know you're across the globe there. Hater Fisternator. All right, let's see. Yeah, so ARM, I still have some of this, so I don't, don't don't kill me for potentially being biased here, but really the trade that we were looking at last week was a sweep of these relative equal lows for a long situation. So I do have June contracts here, not as much as I have in Roblox. I personally like the Roblox setup a little bit better, but I'll explain why I had this idea in the first place. So if you look at this most initial price run from low, you can go to each one of these highs. You'll notice no retracement into discount, right? No retracement into discount means the range isn't set to me. We did get, still no on the weekly, right? No 50% retracement. That's okay. We swept these relative equal lows. And if we come over to the daily here, hold on. on the daily, it's just a tad different because this most recent price run here from low to your high, discount retracement, and look how we're setting up, right? You see these are relative equal highs, right? The way that I'm looking at this is a low resistance liquidity run, meaning that in between these highs, right? Why did we reject here, right? We'd have to go down into like a 5 or a 15-minute candle to see those rejections, right? So if that's the case and we're not using higher time frame levels as rejectors and it's smaller, I think price can shred through here. Okay, so really the one level that to me is necessary or must be beaten is this right here. If you take this out, I think we go ballistic on ARM. That's my take on it. And ultimately, I have if you see it right here, that's where I planned on stopping out if it didn't go my way. So we're good. We're in the green quite a bit actually. Again, it's not my biggest position, but it's okay. I think this could move, right? All these little highs here, right? We'd be taking multiple pools of liquidity, and again, just thinking of it from the perspective of like what kind of sell stop, what is like their stop loss in the form of when it's a short, like how do they get out of that short? It has to be bought. So is there a possibility that price can run through here, turn those additional orders and turn them into uh, you know buys, because that's essentially what it is to cover that short. And to me, yeah, and that would complete my model up there at 164. So yeah, ARM is a pretty sweet setup. Also reminds me a lot of, I'm only kind of equating this by the looks of it and the sector. So a couple months ago, if we looked at, because we nailed SMCI also, you can go on Twitter and just type in my user and do the money sign SMCI. I haven't talked about it really in a long time, so it won't be hard to find. But you'll notice that it was a very similar setup in that we were kind of chopping, consolidating in this vicinity, setting up these highs and ultimately exploding. I know this is a weekly, ARMS is a daily, I get it. But also look at the just the overall price action that had occurred prior to that explosion. So look, betting on anything like this to happen is just insanity to me. I had sold my long on SMCI here at 357, right? So I missed out on this whole move, but I think that is extremely, extremely difficult to sit in, especially when you're trading options on something like that. It's just ballistic. And I didn't have all the time in the world on those contracts either. So, but I think it just kind of has this similar type of look, similar sector. And also just at the very least, just complete the model, which is still about $30 away. And at this exact point, the stop would be about $10 lower. Where I got in, it was a $3 stop to make, 40 something, close to $50. So, and I did get a lot more time on this, so I'm fine with it. But that's ARM. Now for Tesla really just did something that I hate last week, and you'll notice right here it left relative equal lows below right here. Okay, there's one, there's two. To me, I'm starting to think that 152.37 is inevitable. Does that mean that we don't move higher prior to that? No, not necessarily. I think the short-term trade is difficult. Tesla was really, my biggest flop for a while. That's probably my biggest loser just on the year. Had some success on the first run, got stopped. Had some success on the second run, got stopped. Shares, I don't care. I got all the time in the world for that. That doesn't bother me. But when I was trading the options on it, I forget. It might have been this one right here where I got smacked around a little bit. But or no, it was February so I did fine the first couple of times, and then the last time on Tesla I got smacked a little bit. But that's all. I think as a short-term trade, it's a little difficult. Just no relative strength whatsoever. you have relative equal lows, you have buy side liquidity here, and if we do have that bullish structure, you would anticipate a turtle soup type move. So sweeping the 152.37 and ultimately starting to it would likely shred these imbalances as the structure is still, I guess technically bullish in this case. So so that'd be Tesla. I just hate that it left those relative equal lows. I would be singing a different tune if we took this even by 1 cent. Then I'd say, okay, maybe we even get up into the high of this imbalance prior to moving lower, and that's all the way up at 192. But I'm not so sold because I'm not so sure that the low is put in on this most recent run. So that's my thoughts on Tesla there. Hold on, oh, okay. So Lindsay posted Tesla here. Hold on. My phone was just bugging out. Okay, yeah, nice. So Lindsay, if you look in the chat, you'll see you have your high down to your low of that most recent 15-minute price run. You'll notice that price starts to retrace back up to 50%, rejects one more time prior to bouncing just again. You have a bearish fair value gap right up there where we're currently rejecting. Did we leave those relative equal highs? That's the question. Yeah, it looks like that second high didn't take out the first high there. To be honest with you, I would not be shocked that if this would complete my model down here at 160.55. So, yeah, that's not a bad eye. Let's just look at it from an hourly. Oof, look at that. I haven't done this in a while. Okay, so so at this point, that imbalance is null. This would be a situation which we could see on NASDAQ, right? When I talked about that showtime imbalance, right? If we're, technically bullish on a higher time frame and you have that hourly imbalance, you wouldn't really anticipate the model completing at that point, knowing that our higher time frame would suggest higher, but ultimately sweeping this low here. Let's just look at it from this perspective. So what was the price run that took that out from high to low? Yeah, so just for structural purposes, model would complete at 160 with a stop out above 175.49, 175.50. You got one imbalance here. Don't really anticipate that doing much of anything. And even this one here, we've gotten into it about halfway through it already. So I don't know. I just really wish it didn't leave the relative equal lows. If it didn't, then I would be a little bit more unsure about this. But that's just where I'm at with Tesla. So yeah, Lindsay, I think that's a pretty good eye there. So let's see. All right, let's do CMCSA, then we can do AMD and AI, and then we'll call it quits. CMC, hold on. What is this, Comcast? Yeah. Okay. So on Comcast, let's just see what CAD had to say. CAD said, range I'm using is October 23 low to the February high. Okay, February low to 2023 low, okay, to the high here, okay. All right, so here's just a few things, right? So even if you did have the bullish perspective there, I'm not so sure on it just based on the fact that we don't have an imbalance. Like, again, could you be right here? Could we sweep these relative equal lows and run higher? Sure. Just as a way to make it more tradable for me, I would need some sort of imbalance, right? I don't just trade off the fibs blankly. So, wouldn't really be the most ideal setup for me. Here's just one thing that I'd be a little afraid of. Just eyeballing this, yeah, I knew it. You do have relative equal highs, so I'll give you that. But just knowing that we do have a little bearish price run, taking out these lows with that price run here on the higher time frame, and we did get into discount, so that would put me a little bit on edge. If there was an imbalance here, I'd probably try it. I'm sure there was multiple opportunities down here for that to happen, but just because there's not, again, I just try and stay as